Imagine waking up one morning and realizing your money buys less, not because prices suddenly exploded, but because confidence quietly slipped away. This video matters because what is unfolding now will not be announced in advance. It will not arrive as a crash headline, but as a slow structural shift that most people only recognize when it is already locked in. If you want to understand why 2026 matters, where fiat money is heading, and why gold and digital assets keep re-entering the conversation, stay with me until the end. The global financial system is sitting on a level of debt that traditional solutions can no longer fix. Governments have borrowed forward for decades, and today the cost of servicing that debt is becoming heavier than the economy itself. When debt reaches this scale, money stops being a neutral medium of exchange and becomes a political tool. This is why warnings about fiat currency are no longer fringe opinions, but central macroeconomic concerns. At the core of this problem is a simple but uncomfortable truth. Modern money is debt. Fiat currency is not backed by gold, commodities, or production. It is backed by promises, liabilities on a government balance sheet. When those liabilities grow faster than real economic output, the system enters a trap. Raising taxes risks social unrest. Cutting spending risks political collapse. The easiest path left is monetary expansion, even though it quietly destroys purchasing power. History shows this pattern clearly. The 1930s and the inflationary 1970s were not sudden collapses but drawn-out transitions. Debt stress, political pressure, and policy responses combined to weaken currencies over time. Savings lost value, real assets gained importance, and financial power slowly shifted. Today's environment mirrors those periods, but on a much larger, more interconnected scale. Modern governments now face a structural dilemma. Deep austerity is politically impossible, yet unlimited borrowing is unsustainable. Inflation and currency dilution become the path of least resistance. At first, it feels manageable. Over time, it erodes trust. And once confidence in money weakens, behavior changes across entire economies, from consumers to banks to governments themselves. One of the clearest signals of this shift is what central banks are doing, not what they are saying. Quietly and consistently, they are reducing exposure to long-term debt instruments and increasing holdings of hard assets, especially gold. Gold is not a promise to pay. It carries no counterparty risk. It survives political cycles because it exists outside them. If confidence continues to drift toward asset-backed value, countries with real production regain relevance. Energy, agriculture, minerals, and strategic commodities matter more when money weakens. Nations that can feed themselves, power their economies, and supply raw materials hold leverage in any future monetary realignment. But resources alone are not enough. Trust, governance, and financial infrastructure determine whether assets translate into stability. Gold remains one of the strongest hedges against currency devaluation, but it is not a perfect solution. It does not generate income, and it cannot compensate for weak institutions. In future systems, gold is more likely to act as an anchor within a diversified reserve structure rather than as the sole foundation of money. As fiat systems strain, attention naturally turns to digital assets. Claims that cryptocurrencies could instantly erase national debt through extreme revaluations remain speculative. Governments do not fix balance sheets through market optimism, but digital assets do gain relevance when they offer something fiat struggles to provide: transparency, speed, and reduced dependence on debt-based intermediaries. This is where XRP enters the discussion, not as a guaranteed outcome, but as potential infrastructure if regulatory clarity and decentralization thresholds are met. When fiat weakens, the assets that survive are not the loudest, but the ones already built into financial standards and settlement systems. Infrastructure comes before outcomes. Public discussions around strategic crypto reserves, including the mention of XRP alongside major digital assets, are not proof of what will happen, but they are signals. When sovereign leaders and institutions speak openly about digital assets at this level, markets begin to reassess what is speculation and what is structure. The real story is not collapse, it is convergence. Fiat currencies under pressure, central banks rotating toward hard assets, and digital systems moving toward regulation are all happening at the same time. This creates a storm made of structure, not chaos. Those who understand the forces at work are better positioned than those waiting for headlines to explain it afterward. If fiat confidence keeps eroding, Do you think governments will try to protect the existing system or replace it? Share your thoughts in the comments. If this breakdown helped you see the bigger picture behind debt, money, gold, and digital assets, make sure to like this video, subscribe to the channel, and join our Telegram group via the link in the comments for daily updates. We inform, you choose.